Good day. It's a pleasure to be with you. My purpose today is to talk to you about the financial crisis. I'll have to admit I wish I had a subject that was more fun to talk about, but this is a very important issue, not just from an economic perspective, but because of the public policy decisions which are being made that will have a long-term impact on the quality of our lives. This is a very complex subject. I'm going to discuss it in terms of an understanding for an average business person, not expecting somebody to be an economist, but on the other hand, expecting you to have some understanding of business. To discuss this subject properly, it really deserves a 1,000-page book, and I'm going to try to condense it into a 1-hour presentation, so buckle up. I have 3 basic themes. The first theme is that government policy is the primary cause of this crisis. We live in a mixed economy in the United States. We do not live in a free market. That mixture varies by industry. The technology industry is probably 80% free, 20% government. Financial services is 70% government, 30% free. It's not surprising that the most regulated segment of the economy is where we've had our biggest problems. The second basic theme is that government policies created a bubble in the residential real estate market. That bubble deflated, as all bubbles do, and that led to problems in the capital markets and was ultimately transmitted in the economy in general. Finally, there were a number of other factors, major mistakes by a number of financial institutions that added on to the problems. And these were significant errors, but they were secondary in regards to the basic source of the problems, was government policy. How did we get here? We built $800 billion too much residential real estate. We built too many houses, we built too big of houses, we built houses in the wrong place. We should have been investing in technology and manufacturing capacity and agriculture and education. We should have been saving more. How did we make a mistake of that magnitude? Well, if you think about an error of that magnitude, it almost always relates to government policy because it's such a big mistake. And there were 4 primary sources of the problem: the Federal Reserve, the FDIC, the government housing policy, and specifically Freddie Mac and Fannie Mae, and the SEC. In addition, government policymakers took a difficult situation and a natural market correction and made it into a panic. And most unfortunately, almost everything that the government has done since this crisis started will be long-term detrimental to our standard of living. Even if it helps us in the short term, it will hurt our long-term standard of living. How did we get here? The fundamental cause is the Federal Reserve. It's an interesting thing that most people don't really think about. In 1913, the Federal Reserve was created. At that time, the monetary system in the United States was nationalized. The government owns the monetary system. If you have a problem in the monetary system, by definition, it's a government policy problem. If interstate highway bridges were falling down, you would say, well, the government owns the roads, they got a problem, the bridges are falling down. Same thing true for the financial system, for the monetary system. The Federal Reserve was created in theory to reduce volatility in the economy. But actually what they've done is reduce volatility in the short term and created bigger problems in the long term. In a free market, because we're not omniscient, we make mistakes. And the economy is constantly in a rational correction process. Businesses are going out of business that don't do a good job. New businesses are being created, so the economy is constantly correcting. If you try to eliminate that correction process, what you really do is push problems further into the future and create bigger problems. In fact, that's exactly what's happened with the Federal Reserve. In fact, the Federal Reserve itself will admit it was one of the main causes of the Great Depression. In addition, the very existence of the Federal Reserve creates a lot of leverage in the economy. You know, a government entity can borrow a lot based on taxing authority. However, if all you can do is tax, at some point you run into a limit. For example, the state of California can't borrow much money anymore because they've borrowed too much money. But the federal government can borrow a lot of money because not only can it tax, it can also print money. And this leads to a lot of incentives to increase leverage in the economic system. The desire of the Federal Reserve to take out volatility in the economy also creates a perception of lower risk, and that means people save less because one of the reasons we save is because of the risks that we incur. In addition, recent chairmen of the Federal Reserve, Alan Greenspan and Bernanke, made some very serious mistakes. Greenspan kept interest rates what's called negative real interest rates for over 2 years. What that means is the inflation rate was like 2.5–3%, and interest rates were only 1%. And when that happens, that creates a huge incentive for people to borrow. And then Bernanke inverted the yield curve. An inverted yield curves where short-term rates are higher than long-term rates. Markets never invert yield curves. Since banks borrow short and lend long, inverting the yield curve destroyed margins in the banking business and encouraged people to go out the risk scale, because at the same time the Fed was predicting that the economy would continue to do well almost indefinitely in the future. The interesting thing about the Federal Reserve, it's got some really bright people. But I don't care how bright you are, how good of mathematical models you have, you cannot integrate the economic decisions of 7 billion people on this planet. You simply can't do it. The great free market economist, Friedrich Hayek, called that fatal conceit. Fatal conceit, the belief of smart people that they can do the impossible. With that, if the Fed hadn't printed the money, we couldn't have had a bubble. Second cause was FDIC insurance. Now, FDIC insurance sounds good. However, what it does is destroy market discipline. We saw that in our business. We operated in the Atlanta, Georgia area, and we saw lots of community banks starting up using FDIC insurance to raise a lot of money. In fact, we took over one failed community bank where a group of guys that got together that were in the motel business. They put in a little capital. They leveraged that capital dramatically, paying higher rates for certificates of deposit using FDIC insurance. And the typical depositor didn't care because they had FDIC insurance, right? They weren't at risk. And then that bank lent a lot of money to the cronies of these investors in the hotel business, and a lot of those hotels went broke. On a bigger scale, Indy Mac, Washington Mutual, Countrywide, very large financial institutions that failed, were able to finance their high-risk lending business using FDIC insurance. They built branches all over the country. They paid higher rates on certificates of deposit. The typical depositor didn't care because they had FDIC insurance. They couldn't have had their high-risk lending businesses if they hadn't had FDIC insurance. The third factor, and I would call this the proximate cause, was government housing policy. Now, this really goes back a long time, where the government is trying to subsidize home ownership above what's called the natural market rate, under the theory that owning a home is a good thing. Well, owning a home is a good thing in a certain context. There is actually no evidence that home ownership by itself changes human behavior. And if you encourage people to buy too big a house, to buy a house they can't afford, to speculate in housing, young people to buy a house too soon, that's not a good thing. And that's what government housing policy has done. We've been subsidizing housing through our tax policy, which has pushed money out of other investments that would have made us more globally competitive and created more jobs, and we built too many houses even before we got into this bubble. But the precipitating event, what I call the immediate cause, was a decision that really goes back to 1999, made by Bill Clinton. And this was in the context of a number of programs like the Community Reinvestment Act that have strongly encouraged investment in what's called affordable housing, now subprime housing. And what Bill Clinton did in 1999 was set a goal for Freddie Mac and Fannie Mae, these giant government-sponsored enterprises, to have at least half their loan portfolio in affordable housing, now subprime lending. A number of economists at that time said, wow, this is risky. If you look at the legitimate affordable housing market, it's not that big. And if Freddie and Fannie meet this goal, they could get in financial trouble, and it could take out the U.S. financial system, and it could happen in 10 years. 9 years later, it happened.